Today we got to talk about the Savers Credit, known as the Credit for Qualified Retirement Contributions. A lot of you guys have been requesting this, finally getting around to this video. This is a fantastic credit whereby you can not only save for retirement, but also save on your taxes at the same time, and it benefits those who have lower incomes. You know, when I was a young whippersnapper, I really wish I would have taken more advantage of this credit, but I didn't. If only I could just slap my former self. Go! Good morning, everyone. My name is Mike the CPA. Welcome to Money and Life TV. If you're brand new here, we make videos that cover finances, investing, and taxes. Now, it would mean a lot to me if you want to support my work and all the time I spend producing these videos. If you leave a like on this video, engage in the comments below, and if you like this kind of content, certainly consider subscribing to the channel. We make new videos on a weekly basis that cover these various topics to help you build wealth. This is not a how to report your taxes kind of video, but rather I like to demonstrate things on actual tax forms so you can see the full picture and get a complete education on taxes. At least that's what I strive to do in these different videos. Okay, let's go over the rules. And starting off with the form itself, I'm just going to show you this is the form number 8880. That's the form you're going to be looking at. As we discuss the rules, I just want to let you know on the IRS website, you can search for the instructions to this form. It's only one page, so it's really minimal instructions. And a lot of the rules we're going to be talking about are here if you need them. So I'll leave a direct link to this webpage so you can access this for yourself if you have any questions. So first of all, the maximum annual contribution eligible for the credit is $2,000. The $2,000 is the max amount of contributions, whether to your 401k, your IRA, Roth IRA, or another kind of plan that can take advantage of this credit. To qualify for this credit, an eligible taxpayer must be age 18 or over, so basically born before 2003, and they cannot be a full-time student or claimed as a dependent on another's return. You cannot be a dependent on somebody else's return if you're going to take advantage of this credit. We're going to look at the rates on the form here shortly, and the rate of the credit is, of course, determined by your overall income. The higher your income, the lower amount of credit you get. The lower your income, the higher amount of the credit you get, right? Because the system is progressive. The more you make, the more you pay. The less you make, the less you pay. And the credit is available for elective contributions to any of these plans: 401k plan, 403b annuity, or eligible deferred compensation arrangement of a state and local government, 457 plan, simple IRA, traditional IRA, Roth IRA, or voluntary after-tax contributions to a qualified retirement plan. This next part I want to highlight. I don't feel this is going to be the case for many people, but it is something you need to be aware of. It says, with limited exceptions, the qualified contribution is reduced by distributions from the plan made. It says during the year the credit applies, even during the 2 preceding years, or prior to the due date of the return for the year in which the credit applies. So basically what they're saying here is if you contribute money, as you contribute money to these qualified retirement plans, you can take the credit, right? However, if you all at the same time or around the same time, you actually distribute money, take the money right back out, well, it's either going to reduce the amount of credit you get, or it's not going to, if you take out too much, you're not going to be able to take advantage of this credit at all. So basically, if you're going to put money in and then take it right back out, you're not going to be able to get this credit. Okay, let's talk about those AGI limitations to see if you qualify for this or not. The joint column is for married filing joint, of course. Head of household status is right here. And all other filers, including those who are single, you guys would want to be looking at this column as we discuss this. This will make more sense in just a second when we look at the forms. But the max credit you can get on a part of your contributions is 50%. So this is the amount you want. This is what you're hoping to get if your income is low enough. And of course, once your income is too high, you get 0. So we're just going to look at the 50% and 0. And you guys can pause the video if you'd like, if you want to read this and study it. But here we go. So if you're a single filer, the thing to know is if your income is like around $19,500 or $19,750, you're going to be able to get the full credit as long as it's at that or below. If you're married filing joint, you basically need to have income around $39,000 or $39,500, give or take. That's where you can maximize your credit. Your credit phases out once you've made over $32,500 in 2020 or $33,000 in 2021 if you're a single filer. And if you're a married filing joint, your credit is going to completely phase out once you've made over $65,000 in 2020 or $66,000 in 2021. Now let's head over to those tax forms to see how this all plays out. Okay, let's walk through an example so you can see how this all plays out. The taxpayer we're looking at here is Chipper the Cockatiel and his spouse, Penny the Cockatiel.
Stop! Wait! Hold up, Mike! Before you continue, we need to explain to the viewer why you're showing them page 1 and 2 of the 1040 tax form. Alright, listen up, ladies and gentlemen. The reason Mike's showing you page 1 and 2 of the 1040 is because we're trying to get the two different numbers that are going to affect the saver's tax credit calculation. On page 1 of the 1040, we have to figure out what your adjusted gross income is on line 11. The second number that's really important is on page 2 of the Form 1040, line 16, which is the tax line. Those two numbers from those two lines are going to affect how the Saver's Tax Credit Form 8880 gets filled out. All right, Mike, continue.
And they have married filing joint as the return. In our example, Chipper is going to be the sole breadwinner to keep things simple. Chipper makes $40,000 at his job. And we look at the W-2, and as you can see here, I didn't have much time to throw this together, so please forgive me on how ghetto this looks, but I just want to show it to get the point across. So Chipper had total wages of actually $46,000, but he put $6,000 into his 401k. Therefore, it reduces his taxable wages by $6,000, and his total taxable wages is now $40,000, which, as you can see, are also showing up on line 1 of the 1040. On his W-2, throughout the year, he held back in federal income taxes $2,500. Let's go to the tax form now and play this out and see how this foots. But Chipper is really motivated to retire someday. He wants to, he's all about the FIRE movement. So he also, not only did he put $6,000 in his 401k, he also opened up a separate traditional IRA and put $6,000 in there as well. Now, he could have done it with a Roth as well, didn't matter, but in this example, we're just looking at a traditional IRA. When he puts money into a traditional IRA, he's now able to reduce his income by another $6,000. His adjusted gross income on line 11 is now $34,000. Him and his spouse don't itemize. They just take the standard deduction, which is a set amount given to them. The standard deduction is going to further reduce his income. So he's not going to have $34,000 in taxable income. He's only going to have taxable income now of $9,200. The $9,200 is his taxable income, and that is the amount that will be subject to actual taxes, not the rest, just the $9,200. So let's go to the next page and see what kind of tax is calculated on that. $923 of tax is calculated on $9,200 of income, give or take. Now let's look at Form 8880, which is the credit for qualified retirement savings contributions, and see how this all plays out. Okay, on line 1, Chipper contributed to a traditional IRA, so he's going to list his $6,000 there. On line 2, he did in fact put in $6,000 of his own money into his 401k, so he can add that on line 2. And lines 1 and 2 add together to be $12,000. Chipper did not take any money out during this time period, so he has no distribution, so that's why line 4 is blank. Line 5 just happens to be $12,000 because box 4 is 0. So automatically we just carry the $12,000 down. If you read the instructions, you'll see how that calculates. Now in box 6, this is where it gets important. On line 6, it says, in each column, enter the smaller of line 5 or 2,000. So the smaller number of line 5 or 2,000 is just 2,000. And see column B, this is if Chipper's spouse was working or if she was contributing to a retirement plan. Since she did not, then this is basically just going to be blank, okay? So that's why only column A is filled out. So this is Chipper's column, and this is his spouse's column. Now, $2,000 is indeed the max amount of contributions that can come into play for this credit. Even if you put in like $20,000 in contributions, $2,000 per person is the max that will actually help you with this credit. So keep that in mind. Line 8 is really just looking at Chipper's adjusted gross income, and that's how the rate on this kind of stuff is determined. So his adjusted gross income on line 8, it comes from 1040 line 11. Okay, so with $34,000 AGI and he's married filing jointly, does he qualify for the 50% credit? He does, because $34,000 still falls within this range right here. And so they're safe. They're going to be able to get the maximum credit available on those contributions. So what he does, or what you would do, is you take if this is you, take the 2,000, multiply it by 50%, and that gives you a maximum credit of $1,000, or for Chipper $1,000. And it says but there's limitations that further come into play here. On line 11, it says limitation based on tax liability. It says enter the amount from the credit limit worksheet in the instructions. So I'm not going to go into the instructions, but basically this 923, do you recall what that was? That is the tax liability itself. So you can't take the credit basically if you have no tax liability. So on line 12, this is where you get on line 12, you finally determine how much of the credit you can actually take. And since you're limited to the lesser of $1,000 or your tax liability in this example, you have to list your tax liability of $923, which is not bad. It's honestly not bad at all. Because what that does, if we go back to the second page here of the tax form, is that credit of $923 reduces his tax liability of $923 completely to zero. Chipper also withheld $2,500 on his paycheck in withholdings. And so since his tax liability is now zero from the saver's credit, he actually now gets all $2,500 back in the form of a tax refund if he chooses to take it that way. And that is how the saver's credit works. Okay, my friends, well, that's probably more information than you needed, to be honest, but I just wanted to show you the full gamut of how that plays out in that example. As you saw in the example, Chipper not only got a tax deduction when he put money in his 401k, because that reduces taxable wages. Then furthermore, when he put $6,000 in his traditional IRA, then it reduced his income even more that was subject to tax. And then on top of that, out of all that, he also got a tax credit on the back end. So he had tax deductions coming out every which way.
Damn, I'm good.
And you saw he paid no tax in the end in this simple example. And that's how it can work for you. Now, of course, the same would be true if Chipper put money in a Roth IRA or Roth 401k. It would work just the same. So it doesn't matter what kind of retirement plan necessarily you have. I think it covers most retirement plans. As long as you qualify and meet the rules we discussed earlier in the video, as long as your income isn't too high, you can get this credit. A lot of people actually don't know about this. I mean, I wish I had this opportunity when I was younger, and I don't feel like I did, or at least I didn't know about it at the time. Otherwise, I would have totally been jumping on this. Is if somebody's just getting started and you know they don't have a lot of income right now, but you know they're interested in saving for retirement, this credit is awesome. And it really does help out those who have lower incomes. Take it while you can get it, because once your income's higher, you're out of luck. To be honest, guys, I work at a accounting firm here in the Central Valley of California. Most of the clients I work with are upper middle class or the rich. So I never, ever see anybody who can take advantage of this at the firm I work at. Because the clients I work with have a lot more complex tax needs. But a lot of people don't. And so if that's you, you can probably take advantage of this credit. All right, guys, you know what to do. Like the video if you liked it. Make sure to share this with family and friends. I will see you down in the comment section. Look forward to reading everything you have to say. Subscribe for our future weekly uploads around finances, investing, and taxes. I love y'all. Live life uncaged, and I'll see you in the next episode. Peace.